Alright, what's going on, guys? Jeff here, back again with another quick market update for you guys. So I am going to be talking about three companies that went through the earnings report in the last couple of days. Now, these three companies are companies that I might or might not have exposure to, but I've been talking about them extensively on my Instagram stories and such. So let's get started. Number one, we're going to be talking about Meta Platforms, okay? The revenues was pretty good. It was $51 billion for quarter three of 2025. As compared to the previous quarter, they're up about 26% or so. Now, the scare for Meta Platforms was where the EPS actually came in. People were expecting the EPS to be at about $6.30. Meta Platforms showed up with $1.05 for EPS. And understandably so is due to a one-time payment for a lot of tax payment, which is why people didn't really worry about that part. But something people was really taking into account for Meta Platform was about the capex. Now, I've been talking about this capex situation extensively for multiple videos already, or even for multiple Instagram stories talking about it as well. So the reason for the capex being an issue for me is because we have saw what happened with Meta Platforms back in 2022 when they had very, very high capex, which caused the Meta Platform to drop by about 60% or so back in 2022 when they put in a lot of capex into Reality Labs. Now, the capex is being overly leveraged highly in hiring AI talents. Now, I understand that all of them, and by all of them, I mean the whole entire Max 7, the Super 6, the top 100 S&P 500 companies in general. Everyone is trying to be the first to be in the AI space and be successful in the AI space. Now, of course, I wouldn't say that Meta is not doing a good job, but as compared to the other large language models that is currently in the same sphere, people do not really go and say, oh, why not you use Meta AI, right? People will usually tell you to use ChatGPT. You can use Gemini. You can use DeepSeek. You can use Perplexity. So there's a lot of other alternative, and Meta is usually not in that conversation. So a lot of people are starting to worry that is the amount spent by Meta being undermined by the performance of what Meta can actually bring by. So I think that's going to be the concern for Meta in the short to long term. But if you were to ask me, I think that the name of the game is still ad revenue, and Meta is still doing really, really well. So if you are interested in getting Meta, this might actually be a pretty good time for you to get into Meta if you really like Meta as a company. And macros economics aside, Meta is actually not that bad right now. Now, number two, we have to talk about Google. Okay, Google, I've been really, really bullish on Google for the past 4 or 5 years-ish, just about. And they just had the first blowout quarter where they got over $100 billion in revenue for a quarter. So the strong drivers for Google right now is strong cloud business, AI investments, and also the search ad growth. My concern in the recent years or the forward-looking years to come is that search ad growth might be depleting bit by bit because people are not Googling as much right now, whereas they are able to just do it on TikTok. You'll be surprised by the amount of people in the younger generations where they do not Google everything anymore. They just be like, just search it on TikTok. So like back in my days when I was younger, anything I don't understand, like even like how to tie a tie, things of that nature, I would say I will go and Google it. But you can do all of this on TikTok. The amount of content that's on TikTok right now is almost on par with what YouTube has to offer. So I think for the search ad growth, there would come a time where we start to see some stagnating happening. So I think for Google right now, being able to hit this $100 billion in revenue is definitely a huge milestone for them. But I feel that with the scale and momentum that Google have at the moment, we do need to take into consideration that their base business model would still have some implications to look out for. So I'm not going to be too happy about Google right now, even though it did go up by a good, I think, 6 to 7%. It was about 10% after earnings and then kind of just simmered down to about 6% or so. But yeah, I think Google's pretty good. I would be taking a closer look on capex and also margin. I think the profitability and the sustainability of growth is going to be very vital to Google. All right, now lastly, we're going to be talking about Amazon that just dropped their earnings last night. And I think that Amazon is just hitting it out of the park, right? They're doing their revenue up about 12% right now, and their EPS is steadily at about $1.60, if I'm not mistaken. So yeah, I think something that I do want to touch upon for Amazon that is pretty important, which is the latest layoff. A lot of people don't understand for Amazon the reason the layoff is because of AI. People generally would just default into thinking that, oh, the layoffs happen because of AI, because AI is taking over the jobs. Finish. End of story. But that's not the case. Let's be honest. The case is Amazon is a very thin margin business, especially in the retail space, the e-commerce space. They have razor thin margin. They are supposed to be on very, very high volume in order for them to even make good revenue. Where they have the most level of leverage for margin is in AWS. Now, the problem with having AWS being your main driver of income is that it is very GPU heavy because it is a cloud business and a GPU business, very infrastructure, a cloud infrastructure business. So the way that Amazon is going to be building this and scaling this is that they need to be buying a lot of GPUs. Now, the problem comes in is that the demand is really, really high for GPUs, but NVIDIA, on the other hand, they are buying from NVIDIA, and NVIDIA cannot fulfill those demands yet. There's just too much demand for NVIDIA to fulfill. And the problem becomes Amazon would now have to spend even more money to get their hands on Blackwell chips in order for them to continue with AWS, which is making the most amount of money. And in order for them to increase the amount of money for them to spend on chips to help the side of the business that earns the most money, the way for them to do so is for them to cut down costs. Cash burns in businesses, right? So in order for you to find cash burns in business, you have to find costs that can be cut down with minimal impact to the business overall. Top line, bottom line, right? And Amazon realized that the workers are the one that they can let go of. I'm not saying that this is a good thing, okay? But from Amazon's very, very business mind, it's not the worst thing that they can do, because if they were to lay off 14,000 people, they feel that this 14,000 people is not going to be worth more than keeping the 5,000 servers that they have intact and up and running. And on top of that, they feel that they can even bump up and ramp up the AI infrastructure for them to actually support 1,000 more servers, for example. So basically, they are just trying to deploy their capital in a smarter fashion, but in a non-emotional way. They feel that it is better for them to get rid of 14,000 employees in Amazon, for them to ramp up what AWS, the main driver of income, to be. So effectively, that's what happened. It is due to AI that this 14,000 people's job got displaced. But at the same time, it is not as simple as you think. It's not just AI coming in. You know, they came in and then replaced 10 people on the assembly line. That's not how it is, right? It is due to the supply demand of everything and how much money and how much demand for a certain chip or a certain resources is causing this whole entire thing to happen. So yeah, interesting earnings and such. Honestly, I really, really enjoyed this round of earnings. So I hope to see more interesting earnings for the next few quarters. But anyway, that's all I got for this video, and I'll see you guys in the next one.